If I had to choose one strategy to trade for life, it would be the one candlestick strategy that I've showed you guys several times here on the channel. Now, some of you have been asking me questions in the comment section down below, and I'm going to try to answer all of those questions in this video. I'm going to show you how you can trade the one candlestick strategy effectively using a top-down analysis from a higher time frame to a lower time frame for you to get your entries. I'm going to give you at least 2 to 3 techniques for you to find very good entries. And some of you have also asked me how to draw the candles if, for example, a candle doesn't have a wick or a candle is a doji. I'm going to show you all that in this video. So don't skip the video, watch the video from the beginning to the end so that you don't miss this important information. Guys, remember, if you're new to the channel, give a like, subscribe, and also comment down below with your questions. Now let's get started. All right, guys, so we are here on the screen, and what you're looking at here is just illustrations that I have drawn for you guys to explain to you how you can do the markings for the one candlestick strategy. Now, I know I have done this several times, but there are new people on the channel who don't know how to draw the markings on the one candlestick strategy. Now I'm going to just give you guys a breakdown of how you can be able to trade the one candlestick strategy, but beginning with the markings. Now, the one candlestick strategy is a momentum trading strategy which trades reversals and also continuations in the market. Now, how do you draw these markings? Let me show you first what you need to consider before you draw the markings. When you're going to draw markings on a bullish candle, for example, this green candle here is a bullish candle. It shows that there is bullish momentum in the market, right? You don't want to draw or mark a red candle during a bullish trend. Like, for example, if the market is creating higher highs and higher lows, the market structure is showing you that the market is actually trending going up. You don't want to mark the red candles in a bullish market. Now, how do you determine a bullish market structure? You determine bullish market structure by checking the most recent highs. Are they being broken by the market? Are the candles breaking above most recent market structure like this and retesting like that? Is the market actually pushing up, breaking most recent highs like this? That confirms to you that that is bullish market structure. And also for bearish market structure, you want to make sure that the market is breaking recent lows. Like this low is broken by the market and the market retests it. Market is breaking lows. That's how you confirm that the market is bearish. So in a bearish market structure, you're only marking red candles or bearish candles, and in a bullish market structure, you only mark bullish candles. Now, some of you were asking me, what about if I find a red candle in a bullish market structure? What do? You ignore that red candle and wait until you see a green candle in a bullish market structure for you to mark. Don't mark red candles during bullish market structure, and don't mark green candles in a bearish market structure. So after you have done that, other thing you can do to confirm whether the market is actually bullish or bearish is put a 20 period moving average on your chart. For example, if this is bullish market structure, you want to see a 20 period moving average has crossed below the price or below the candles like this. This blue line here represents a 20 period moving average. So you want to confirm a bullish market structure or a bullish trend by adding a 20 period moving average on your chart. Now, also in a bearish market structure, you want to see a 20 period moving average crossing above the price like this. The candles should be below the 20 period moving average. That's when you confirm that the market is trending down. Now, some of you have been asking me which type of moving average is that you're using. It does not matter which type of moving average you use. You can use a smooth moving average, you can use a simple moving average, you can use an exponential moving average. All of them work. What matters mostly is the period that you are using. You need to use a 20 period moving average. It has to be a 20 period moving average. Whether simple, exponential, smooth, whatever, it has to be a 20 period moving average. Now, also another question you've been asking me is that why did you choose to use a 20 period moving average and not a 50, a 10, or a 100? Now, a 20 period moving average counts the average price of 20 candles for that specific time frame that you are on. For example, if you're on a daily chart, the 20 period moving average is counting the average price of 20 candles. And we know that in a month we have 20 trading days, because every week we have the market open for 5 days. Times 4, that is 20. Okay, so we have 20 trading days in a month. That is why I use a 20 period moving average, because I am looking at a period of 1 month to gauge the trend of that 1 month for every time frame which I am looking to analyze. If you put in a 50 period moving average, it means you're extending the average range of price that the market is going to determine to draw the average on the chart. It will mean it is going to show you the average of 50 trading days. That will be like 2 months of trading, 2.5 months of trading actually. So for me, I just want to consider the most recent trend, which is 20 days. So if I put a 20 period moving average on my chart, it is going to show me on a daily chart the average of 20 trading days. If I put it on a 4-hour chart, it's going to show me the average of 24-hour candles. So I'll be able to know the most immediate trend. So that is the reason why I choose to use a 20 period moving average. That question, I believe, has been answered now, because you guys have been asking that several times in the comment section down below. Remember guys, if you're watching this video and you're finding value, leave a like on the video, subscribe to the channel, share this guys with your friends on your social medias. Let this video be found by traders who are also looking to learn how to trade properly. All right, so let's move on. Now, if you've determined that the market is in a bullish trend like this or in a bearish trend, what you're going to do is you are going to mark the most recent closed bullish candle. That's also a question I've been getting. Do you mark the printing candle or do you mark the closed candle? You mark the closed candle because it's the one which has confirmed the closed price. You don't mark the candle which is open because it is still printing. You don't know what price it's going to close at. Okay, so you mark on a bullish candle, you mark the closing price which is on top like that. Okay, let me just make this blue, and then you mark its low like this, right? And then in a bearish candle, you want to mark its a high. Let me just adjust this so that we have the same line on. Just put the same line. If it's a bearish candle like this and you're trading in a bearish market, you mark the bearish candles high and you mark the bearish candles close. So you would mark its close. Let me just extend its close down here like this. So this is how you would mark a bearish candle. It's a high and close. A bullish candle, you mark its close and its low. And then the space in between those two lines that you've drawn will be called a tradable zone like this. That space in between is called a tradable zone like this. This tradable zone in a bullish market means that you are waiting for the market to pull back inside of this zone for you to trade and continue the momentum of this previous bullish candle based on general market psychology, which dictates that if this candle closed bullish, it means that majority of the people in the market, or the general market psychology, believes that the next candle is also going to be bullish. So you want to also trade into that momentum, but don't trade at the close of this. You wait for the market usually to pull back in to give you a discounted price, then you get an entry to trade to continue this momentum. However, this does not happen all the time. What happens sometimes is that the market will pull back inside of this zone and just continue down like this and break the low of this candle. So here you just wait for the market to pull back up a bit into this tradable zone here, and then you can look for reversal trades to sell. Okay, now in a bearish market, you just do the opposite. You're waiting for the market, the next candle, to pull back inside here or near that zone, and then you look for sells. But also sometimes the market can just come inside here and then just keep pushing up and break that candle's high. In that case, wait for the market to pull back inside of this zone here, and then you can look for reversal trades to go bullish. Now, this is the essence of trading the one candlestick strategy. Now, one very common question I've got in the recent days is, how do you mark if these candles here are a doji, or if this candle does not have a wick, how do you mark it? And I've always told you, do the same thing. For example, this bullish candle, let's assume it doesn't have a wick like this on top and at the bottom like this. It has a very small wick, for example, at the bottom like this. How do you mark this? Just mark its close on top and then mark its low. The low is the same as the open if the candle does not have a wick. Then you put a tradable zone in the middle like that. Same thing is true for a bearish candle. If you don't see a wick, just mark its a high point, which will be the same as its open, and then mark its close. For example, at the bottom, if it doesn't have a wick like this, just mark its low like that, which will be the same as its close. Now, I have a complete course that I've put together for you guys. It's a detailed course that teaches you how to do all these markings. I'll leave it at the end of this video or in the description of the video. Just go watch that course. It will explain to you how to mark all these, including the dojis. But I just wanted to make this clear for you guys so that you understand this. Now, if it is a doji, for example, let's assume that it is a spinning top doji or whatever. Let's assume this candle is like this. It closed like this, okay? If this candle closed like this, follow the same principle. If you follow the same principle, you'll not get lost marking these candles. What you do, you just move the box down here and move this line to the close of that candle like this, and then mark also its low. If there's a wick down here, just mark the low like this, okay? And let this be the purple box or the tradable box. Even if this candle here is a very tiny doji, let's say it's like this, okay? Just mark the low and the close like that, and you will still have the same effect, okay? Just do the markings. Follow the steps to do the markings. It doesn't matter what shape the candle is. What you need to know is a bullish candle, even if it's a bullish doji like this one, just mark its closing price and its low if it's bullish. And if it's bearish, if it's a bearish doji, for example, if it is like this, let's assume it's like this, bearish, just mark its a high. For example, in this case, you would mark its high on top here like this, and then you would mark its close. You adjust this to its close down like this. So that would be your tradable zone for this bearish doji. All these things will work the same way. Just know the principle that the bearish candle, you mark its high and mark its close. For a bullish candle, you mark its low and mark its close. If you understand this, you will be able to mark the one candlestick strategy markings on a higher time frame and then get your entries on a lower time frame. Now, another question that you guys have been asking is, how do we determine the entry time frame? Now, this is what you need to follow. On a 4-hour chart, if you mark this candle on a 4-hour chart, use the 5-minute chart for your entries. If this candle you've marked it on a daily chart, use the 15-minute chart for your entries. If you've marked this on a weekly chart, use the 1-hour chart for your entries. If you've marked this on a monthly chart, use the 4-hour for your entry. That is what you need to follow for you to be able to do this successfully. Now guys, I have done illustrated this for you, and I hope you guys have understood this. If you not understood this, watch the video again and you'll understand this more clearly. Now, I want us to go and do a very short bar replay for you guys to see how you can implement the one candlestick strategy in your day-to-day trading. All right, guys, so we are here on the gold chart. This is a 4-hour chart. I want to show you this for day trading. This is a 4-hour chart. As you can see up here, it's a 4-hour chart on gold. And now, I want you to follow these steps as we've discussed in the previous steps in the video. Just check, for example, here we are on the gold chart, 4-hour chart. What you need to check first is, where is the trend of the market going? We can see that this trend here is bullish. It's creating higher highs and higher lows, as you can see. We can also confirm that the trend is bullish by this 20-period moving average. As you can see, this is a 20-period moving average. So you can see that the 20-period moving average is below the candles. So that confirms that the trend is actually going up. So we can see this candle here that I have marked, it has no wick almost at the top. You can see this is what you guys were asking. It has almost no wick at the top. I've marked these candles close at the top, which will be the same as its high, and I've marked its low at the bottom. Then in between, I've put this tradable zone here, this purple box. Now, since this is a 4-hour chart, I am going to go down to the 5 minutes chart to get entries. So we are here on the 5 minutes chart. As you can see, guys, this is a 5 minutes chart, and this is the same purple box that we have drawn on the 4-hour chart. Remember, guys, if you're finding value with the video, give a like on the video, subscribe, and also share this with your friends, guys. Let's make this video get discovered on YouTube so that many other people can benefit, guys. Thank you in that regard. I really appreciate your support. All right, so here on the 5 minute chart, if we play, we are going to get entries within this purple box. So what we are waiting for ideally is the market should pull back inside of this tradable zone here to give us a discount price to continue the momentum of the previous candle that we developed this zone from. All right, now let me just play so that I can show you the techniques, that at least 2 or 3 techniques that you can use to find entries. Now let's just play along. You can see the market has pulled back inside of the tradable zone. All right, so what we are waiting for now on the first technique is we are going to wait for the price to break below this moving average right here. And next time it breaks above the moving average, that will be our first entry. Okay, so let's play along and see. Okay, all right, now this is going to be our first entry candle, this green one here. We're going to place an entry there. Okay, we'll place entry here, and our stop loss will be ideally below the most recent low, which is down here. Okay, so our stop loss will be below that low here, and then we'll target a 1 to 2. Always try to look for at least a 1 to 2 risk to reward ratio. Remember, guys, when you're watching this, don't take this as any financial advice. I'm just showing you how I trade the one candlestick strategy, and hopefully you guys can also implement this in your trading so that you can improve your entries and also learn how to trade better in the FX market. So let's just play this along and then we see. So that will be our first entry because the market has broken above the 20 period moving average after breaking below it here with this red candle. So let's play along. Market goes up, we're in drawdown, market goes into profit now. Just play this along, goes into profit. Okay, market is still above the moving average, so we are confident it's still moving up. All right, let's see what happens. Let's see if we get take profit. Okay, there we go, we get take profit right there. The market reaches take profit. Now that's the first technique that you can use to find an entry. Once the market breaks below the moving average, the next candle that breaks above it, that will be your entry. Now if you missed that first one, you could have gotten in here on this next one here. For example, here you would have taken a trade after that candle breaks above, and then you would use this area now because this would now be your next most recent low here, and then you would target a 1 to 2 like that. You would still win that trade. Actually, this trade would reach take profit much faster. Okay, now if you did not want to get an entry using the moving average, you can also use just candlestick patterns. Okay, you can just use candlestick patterns. When you see, like for example, a big candle, big bullish candle engulfing a red candle, you can enter from there. For example, here we can see that this is a very big candle here. Okay, very big candle which breaks the high of this red one. If you're not satisfied with how big this candle is compared to the red one, you can enter here where you see this engulfing candle here, bullish engulfing here above the moving average inside of the tradable zone. You can also enter from there, like for example after this bullish engulfing closes, and then you would put your stop loss below the moving average here. Okay, and then you target a 1 to 2 like this. This would still win you using that entry using the candles. Okay, just the candles. You can use a break of trend line here. For example, here we had at least 2 touches of a trend line. For example, here we had first touch, the second touch, and then you project it forward like this. When the market breaks above that trend line, you see that ideally it also breaks the moving average. So that will be a confirmation. That would be also a confirmation for you to enter trade there. Your stop loss in this case would be below this previous low, and then you take your 1 to 2 there like that. So these are different entry techniques that you can use. If you don't want to use the trend line, you can also use a Fibonacci. You can use a Fibonacci, since this is an uptrend, you draw it from the most recent low, which would be this one here. Draw it from here to the most recent high, this one here, before this pullback. Okay, when you draw your Fibonacci from this most recent low to that most recent high and project it forward like this, you'll see that the market comes down to the golden zone. You can see here that the market actually pushes up and then comes down to this golden zone. You see this golden zone, this area between the 50% and 61.8. You can see the market comes into that golden zone and then starts to reject from there and start going back up like that. Okay, so that would be also a confirmation for you to enter. Now, how do you enter using Fibonacci? Using Fibonacci, you just wait for the next candle that breaks above the golden zone, which would be this candle here still, this one. You would still enter after that candle breaks and closes above the golden zone. So that would be your entry technique using Fibonacci for you to continue. And for this case, your stop loss will be below the golden zone. Then you'll target a 1 to 2. Guys, if this video has brought you value, give a like on the video, guys, subscribe, and also comment down below. Also go and use the links in the description to follow me on Instagram, follow me on TikTok, follow me on Telegram, and don't go and search my name there because you'll be scammed. All right, so guys, let me see you guys in the next one. Thank you for watching. Until next time, peace and out.